How much can one American jobs report really move your money? Today it could decide where the pound goes next. On Tuesday, the 4th of August 2026, sterling has found its footing at 1.3420 against the US dollar, carving out a narrow range through the London session rather than pushing decisively in either direction. That stability is not conviction, it is caution. Traders are sitting on their hands ahead of the United States job openings and labor turnover survey, the Jolts report, which lands later in the day. It measures how many unfilled vacancies American employers are advertising, and it has become one of the most closely watched signals of whether the U.S. labor market is genuinely cooling or simply pausing. The reason this particular release matters so much is that job openings act as an early warning system. Vacancies dry up before redundancies rise, so a weaker headline points towards a softer American economy and a softer dollar, while a stronger figure hardens the case for interest rates staying higher for longer. Meanwhile, the wider currency board has been anything but quiet. The euro has been advancing as expectations build that the European Central Bank is leaning towards further tightening, and that has pulled capital across the Atlantic. At the same time, the Japanese yen has been on the back foot as fiscal concerns in Tokyo unsettle investors. Sterling, caught between those two currents, has effectively been given permission to do very little today. A pound parked at 1.3420 has real consequences. For a UK family heading abroad this August, it means holiday money is worth broadly what it was worth last week, which is welcome after a volatile year. For importers buying goods priced in dollars, from fuel to electronics to raw materials, a steady rate makes forward planning far easier and reduces the cost of hedging. British exporters, on the other hand, are not getting the competitive lift a weaker pound would deliver. It is not just sterling. TD Securities has flagged that Canada's trade surplus is expected to narrow, keeping the Canadian dollar sensitive to its own data. Across the board, currency markets are being driven by economic releases rather than sentiment this week. So where does this go next? The honest answer is that 1.3420 is a pivot, not a destination. If U.S. job openings come in below expectations, the dollar is likely to soften and sterling would have room to test higher ground. A robust number does the opposite, pressing the pound back down and reinforcing the argument that American rate cuts remain some way off. Watch the euro too. If ECB tightening expectations keep firming, euro strength can indirectly drag sterling along or leave it lagging on the cross. The yen remains the weak link while Japanese fiscal questions linger. Expect a quiet morning followed by a sharp, data-driven move, which is the classic rhythm of a release day. The lesson here is simple. A compound is not a boring pound, it is a coiled one. Sterling holding 1.3420 tells you the market has no strong view yet, and that vacuum will be filled the moment the US jobs figures hit the wire. If you are converting money, paying an overseas invoice, or trading this pair, the window before the data is the predictable part of the day. After it, all bets are recalculated. Keep your eye on the vacancies headline, watch how the dollar reacts in the first 15 minutes, and remember that in currency markets, the quiet hours are usually the ones setting up the loudest moves.